Tom Lee just dropped one of the boldest calls yet, saying the S&P 500 could hit 7,500 by year end. That's an aggressive move considering how far we've already come and how stretched valuations look right now. So before we panic or pile in or say that's too high or too low, smart investors, what they're doing, they're positioning for both outcomes. So in this video, I'm going to break down why Tom Lee's comments might have merit, where the risk lies, how to hedge without sitting out, and I'll even show you a live trade and how I'm hedging on the trading platform. So be sure and hit like and subscribe, and let's jump into it. So let's be fair. Tom Lee's not making this up out of thin air. There's a strong setup for a year-end rally. There's market momentum that's been strong for 6 months straight. Inflation's cooling faster than expected, and liquidity is quietly expanding again. But here's what really fuels this prediction. It's not data, it's doubt. Sentiment remains deeply negative. You've got Wall Street strategists still warning about a recession while the market's breaking new highs. We've also got the government shutdown. When's that going to end? Well, there's a disconnect. It's rocket fuel. Historically, when everyone's waiting for a pullback that never comes, the pullback becomes the next leg higher. So yes, 7,500 isn't impossible, but it's also not a free ride because markets don't climb forever, and smart money knows exactly when to take the edge off. Now we're still up 15% year to date in the S&P 500 and 26% in tech stocks alone. So all the sectors are up big so far this year. So we're still at that euphoria stage. And here's the truth. We're at extreme optimism levels still. Fund managers are chasing benchmarks. Retail traders are piling back into tech, and volatility is scraping the floor. When everyone's leaning one way, risk piles up on the other side. That's why it's the exact time to hedge, not to panic, but to prepare and position. Now, hedging can be simple. We can lighten up on extended winners. We can buy protective puts on overbought positions. So I like to use the Qs. And we can rotate a small slice into defensive sectors like healthcare or staples. So don't think of it like you're betting against the market. I'm long-term bullish on the stock market. But when we're at all-time highs and there's that 10 or 15% pullback, I'd like to be the one with some cash on the sidelines and even making money on my hedge on the way down. It's a small price to pay for just being consistent. So here's the mindset that most investors never make. You don't have to be extremely bullish or bearish, but you can just be strategic. And the market doesn't reward emotion. It rewards consistency. That's why timing the top is completely impossible, because even if you sell early, you have to nail the re-entry. And statistically, that's where almost everyone fails. Over the last 20 years, missing just 10 best market days cuts your total returns in half. That's why I like to stay invested, but always with a plan. My approach is simple. Stay 70 to 80% invested in the quality positions. Keep 20 or 30% in cash or hedges for pullbacks when we're at market highs. And add selectively when that fear spikes and everybody panics and gets out of the market. That's when we want to pile in. All right, guys, we are on the Tasty Trade trading platform and brokerage, my favorite for trading options. There's a link down below. Benefits if you go through my link, so check it out. It's super intuitive for trading options. And we're going to look at the Qs today. They are up 0.77%. So good time to put on a hedge, add some more negative deltas. You can see I've got negative 32 deltas on a calendar, or a poor man's covered put is what it is. So here's how we do it. It's a hedge. And what we can do is go to the trade page. We're in table mode. And I'm going to take it off the weeklies. I like to trade the regular options. And I'm going to go out long term. Let's go out about 100 days. So February. I'm going to go just in the money right here. We're going to buy the 625 put. So boom. And if you look here on curve mode, you can see as the stock price goes down, that's when we profit. And you can go analysis mode, and you can see it profits more and more the deeper it goes down. So this is how we hedge. When the market goes down, we make money. So $26 is really times 100 shares, $2,600, because one option contract controls 100 shares of stock. So that's the beauty of utilizing options. Now we can go back to the table mode, and what I like is we can sell a put against it and collect income while we've got this hedge on. So I'm not concerned about the stock market going to zero. I'm more concerned about a 15% drop. So what I'm going to do now is we've got that February 100 days on that we bought. Now we are going to fund it, or part of it, collect some income with the December 44 days out. I'm going to sell a put. And when we sell a put option, we collect money. So that's going to bring down the cost of this protection from $2,600. Let's see what we can collect. If I want to collect have basically a 10% protection, so 624 times 10% is, what is that? About 60 points. So from 624, we need to go down to about 560. Let's see what we can collect there. I've already got the 560 on, and we can collect $3.31. I actually like that. Boom. Brings our cost down to $22.59. And we're doing this in the short term, 44 days to expiration. So you can see on curve mode, that caps our profit, but we still make, if it were to drop down below the 560, we still make $7,763 on a $2,200 investment. And you can trade as many contracts as you like, but be careful. It just depends on the size of your portfolio. But I'm going to go ahead, hit review and send, and look to place that trade. Looks like I've got to adjust it slightly. Let's go. There we go. We're filled. All right, guys. One other trade I wanted to cover today, Super Micro. They're getting slammed, 9.5% down. Wow. So, hey, what are we going to do? Has our long-term outlook changed? No. Super Micro has these big swings, and at $42 where it is now, I'm more bullish, so not concerned about it. But what I'm going to do, I've got 3 leaps and 3 calls that I've sold against it. You can see those calls that are profitable. So that's why I like to have the calls on. So when there are these pullbacks, we can profit from it. So I'm just going to go ahead and close these out. I'm going to click on them both. I'll close them all at once. And click to close. We'll pay $278 to close them. Boom, closed. Now I'm completely long SMCI right here. So if we go to trade, curve, analysis, you can see as the stock price goes up, we're going to profit big. And I'll wait for a big up day, and it'll come. And then I'll throw on some short calls again and sell against it. But let's look real quickly at what actually happened in the market. I just punched it in perplexity. I'll do a deep dive into the earnings and see why they missed and how they missed. And I mean, it looks pretty bad, but I just punched in what happened with SMCI today and why is it down so much. And there we go. They missed Wall Street's expectations on their earnings, and it talks about the numbers. They delayed deliveries for some clients, pushing orders to next quarter. So that revenue is still going to happen. And there's nothing in here that really, I mean, it's not good, but does it scare me away from what Supermicro is going to do over the next 1 or 2 or 5 years? No, they're in the data center. I go to my my notes on SMCI. My target is 60 to 80. They are the leading provider of servers, liquid cooled, and they're growing at 40% plus in the AI server market and trading at 1.3 price to sales, less than that now. And, by 2030, their stock could be 350, 400. They guided 40 billion in revenue next year, and it could be in the hundreds next year. So I've got no problem with it. If we look at the chart long term, look at where it was at one point, just back in 2024, way up there. How high did it get? Wow. It got up to 114. So yeah, you can be back in the hundreds, but right now it's down here. So it's on sale, 48. Yeah, they had some bad news and a bad quarter, but long term, I doubt that that's going to be a concern, but I'm going to review the earnings. I can do a deep dive. Let me know in the comments down below if you want me to do that and review the numbers and why it was down. But it kind of outlined it there. But what I did right now, I don't panic. What I do is just close out those calls, and then I'll wait for it to recover, which it will. And you look at this trend, it's at the bottom of the trend, so good time to get in, and then I'll sell those calls against it. All right, guys, let me know in the comments below. Are you hedging right now with the market still at all-time highs, and how are you doing it? So really, the key to this video and what I'm trying to get across is stay invested, hedge, have some cash on the sidelines when we're at all-time highs like this. Position for both the upside as well as a pullback so that we can profit on the way down. So remember to like and subscribe down below. There's a link to my free private Discord. This is new, guys. I'm just setting it up. So it's not always going to be free, but right now it's free, and it's free for life. So get in now, and I'm going to show you the trades that I'm putting on, so you'll see those, and I'll put out trade alerts, and you'll see all my trades. So it's a great place for us to communicate and share trade ideas as a community, and we'll build that community over time. So really appreciate you signing up for that and joining. And also, there's an options trading mastery course that is on sale right now. There's a free options workshop, so you can check that out in the links below, as well as the course, but it's at its lowest price ever right now for $97. So go ahead and check that out, and I'll see you in the next one. Watch this next video as well.